Good evening, everyone. I hope all of you have been keeping safe and well. My name is Nicholas Keong, Head of International Residential Project Marketing at Knight Frank, Singapore. Now, despite all of us being confined to our own homes at the moment, we're extremely delighted we're able to gather online and speak to all of you this evening. Around the world, everyone continues to battle against COVID-19, which has already had massive impact on the economy. In response, we've seen unprecedented levels of government spending and interest rate cuts to underpin the economy. Many of you are already proud owners of a London property. Many may be planning a purchase in the near term, perhaps for your children to use while studying there, or as an investment to diversify your portfolios. This evening, we have an amazing panel of experts presenting, which we hope everyone will find invaluable. Tom Bill, Head of London Residential Research at Knight Frank, will provide the latest market insights. Jamie Morrison, Head of Private Clients at HW Fisher, will provide an update on tax further on from the UK 2020 budget. And David Hall, Head of New Homes Knight Frank Finance, will cover the latest movements in the UK mortgage market. Along the way, if you have any questions, you may use the chat box function on the right-hand side of your screen. If you're on your mobile, this will be in the top right corner. Without further ado, I'd like to introduce my colleague, Tom Bill, Head of London Residential Research.
Thank you very much, Nick, and good evening, everybody. Thank you for joining us for this webinar event, and hello from London. What I'm going to do is split the presentation into three themes. First, I want to take a brief look at what was happening in the property market before COVID-19 came along, and then I'll take a look at what's different between now and the last recession, 2008, 2009. And then what I'll do finally is explain what both of those things tell us about how the residential market in the UK and London is likely to emerge from this downturn. So first slide, please. First, as I say, a quick reminder of where we were. What you can see on this chart is annual rates of growth for prices in the UK, Greater London and prime central London. Now, what's clear is that property markets across the UK underwent a period of repricing and were beginning to stabilise in 2019. And this was something that was happening before the general election came along. This adjustment in prices happened as a result of tax changes, including the stamp duty and A10. Many of you will be familiar with these terms. And of course, it was also due to the volatile political climate that we've had in the UK in recent years, including Brexit. So when we think about what's going to happen next, it isn't about picking up where the so-called Boris bounce left off or the general election effect. It's a process that started long before general election. Just by way of an example, in 2019, in prime central London, we had the highest number of transactions that we've had for 5 years, and that was across the whole year. So it wasn't just a general election effect, the longer term trend. And just to sort of further that example, in prime central London, in the so-called golden postcodes, Mayfair, Knightsbridge and Belgravia, prices on average last year were £150 per square foot below their 5 year average. So the point of showing you this slide really is just to give you some important context to bear in mind as we consider how London and UK markets are going to emerge from this. The key point to make is a longer term price adjustment has already been taking place. Next slide, please. And this chart, I think, really just makes that point even more graphically. What it shows is how weak price growth was in the 5 years February compared to when we went into the last recession. You can see the chart on the left and the chart on the right. So going into the last recession, into the peak of price growth across the UK was November 2007. Prices in the UK grew by 70% over the previous 5 years. This time round, it was much lower. As you can see in the chart on the right, the red bar, prices grew by 21%. Now, in prime central London, last time around, we had 74% growth in the run-up to the last recession. This time round, prices have fallen by 12% over the last 5 years. So this, as I say, is an important factor to bear in mind for those people who are predicting sizable double-digit price growth for price drops this time round. In simple terms, there is very little meat that's been put on the bone in terms of house price growth over the last 5 years, and this will act as a brake on any price declines that we expect to see in 2020. Next slide, please. Another key difference this time round is that the property market is not out of balance in terms of supply and demand. What this chart shows is data from the RICS for London that looks at supply and demand. And if you look at March 2020, you can see both supply and demand effectively fell off a cliff at the same time. Now, if you look back to 2008, that simultaneous movement in supply and demand didn't happen. There was a fall in demand, but an increase in supply, and that was the catalyst of such large price falls last time round, 20, 25, 30% in the space of the year. And much of that was, of course, forced sellers who were struggling with higher interest rates, something I'll come on to in a moment. So the fact that supply and demand have both headed downwards at the same time is a second key difference between now and 2008. That will also act as a brake on any price falls. Next slide, please. This next chart shows the link between the UK economy and its housing market. The first thing that stands out is that the red line, which is prime central London property growth, jumps around a lot more. It goes higher and it goes lower depending on what's with the economy. And what that tells us is that any recovery is likely quicker and steeper in prime as opposed to mainstream markets, particularly in London, of course, where international demand will play its part. Now, the second thing that this chart tells us is that if you go back one chart. Thank you. The second thing that this chart tells us is that if you look carefully over the last 5 or 6 years, the link between the UK economy, which is the green columns in the background, and what's happening in property markets, which is the orange and the red lines in the foreground, that link has weakened. They're not moving so much in tandem. And the reason that that's happened, or the two reasons that that's happened, are the ones that I've already mentioned. The political uncertainty that's been in the background and the fact that the government has directly intervened in the housing market with tax hikes. So if you're looking at this slide, the first conclusion to draw is that the prime market in London will probably be quicker to respond as we emerge from this pandemic. And the second conclusion is that as issues like Brexit and stamp duty, which are still issues, which are still concerns for many people, as they continue to finally work their way through the system, this will also temper any price decline. Next slide, please. You've seen this one already. It just shows you the economic modelling that we factor into our thinking. You can see here 3 different economic forecasts for what UK GDP will do. Oxford Economics forecasts a drop of 5.1% in GDP this year for a 6% increase in 2021. The OBR, the Office of Budget Responsibility, forecasts a much steeper drop. But what they all do, what the pattern shows, is a very steep decline in Q2 this year, followed by a pretty sharp uptick towards the end of this year and into 2021. So when we put the housing market data and the economic data together, what we've come up with is a price forecast of -3% in 2020 across the UK, before growth of 5% in 2021. And remember also where we're coming from. The Nationwide and the Halifax, 2 leading house price indicators, have come out. The Halifax was this morning predicting demonstrating strong growth in the year to April. The Nationwide reported 3.7% growth in the year to April, which was the highest figure in more than 5 years. It partially captures the effect of the pandemic, but it's important, as I say, to remember where we're coming from. Now, for prime central London, for the same reason, we've penciled in 0 growth this year. Some parts of prime central London have fallen by 25% over the last 4 or 5 years, and that has to have an impact on what comes next. So as I say, 0% growth before a bounce back of 8% in 2021. Now, of course, events are very fluid at the moment. Short-term forecasting is a risky business. It's subject to constant review. What we are seeing at the moment is lots of ad hoc price renegotiations taking place. Normally you talk about prices falling and rising on the back of comparable evidence. That comparable evidence is not so much there at the moment. What we're seeing instead is buyers and sellers looking at 5-10% renegotiations, because that's a figure that they perceive to be a risk appropriate, take into account the effects of pandemics. But just to repeat, anticipating how property markets emerge from this pandemic isn't about picking up where Boris Johnson left off after the general election. It's about longer term price trends, and those are our forecasts for the full year. Next slide, please. This slide explores two other ways that this current downturn is different from 2008. First, the chart on the left shows unemployment is not expected to climb as high or be as prolonged as it was last time round. We have other forecasts that again spike higher, but the same pattern is there. It's coming back pretty much just as sharply. In large part, this is due to the unprecedented government support that is being provided in the UK in the shape of a furlough scheme. So Oxford Economics expects forecasts unemployment to peak at around 6% before falling back much more quickly than last time. Other forecasts, as I say, are higher, but there is broad agreement that this won't take the similar shape of the 2008 recession. You won't have that overhang of unemployment in the same way you had last time. Now, to draw your attention to the chart on the right, that's just a reminder really of just how low interest rates have been for the last decade. And what this has done is provide a very stable backdrop for the housing market over recent years. We haven't really seen a lot of strong double-digit price movement up or down compared to previous cycles. So some stability despite all of the tax changes that we've seen. So the point to make, if you're looking at the housing market data and the economic data, you come to the conclusion, I think, that comparisons with 2008 are of limited use, and there are reasons to believe the property market will come out of this downturn much more quickly. Next slide, please. Now, all of that said, we of course expect a major impact on transactions in 2020. Overall, we expect the number to be 38% lower than 2019. That's around 526,000 lost sales compared to last year, with fewer than half of those expected to carry over into 2021. Now, we would expect the bottom of this trend to occur in around June or July, given the fact there is very little new supply coming onto the market at the moment, before returning to broadly longer term normalized levels by the end of the year. What we're seeing at the moment is that buyers and sellers are preparing themselves for a fairly unusual seasonal pattern of activity in 2020. Buyers are getting onto waiting lists for viewings for when lockdown measures are relaxed, and we'll hear more from Boris Johnson, Prime Minister, about this on Sunday. And some sellers are doing all they can to get first mover advantage for later in the year. So as I said previously, we would expect prime London markets to outperform in terms of transaction volumes, but this is the pattern we expect to play out this year in terms of sales volumes, all of which was based on an assumption that restrictions would be lifted from June. As I said, given what the government is likely to announce this weekend, we can expect some relaxation to take place before then. Next slide, please. Interestingly, when we look at China, we can see a similar pattern having played out. So you had a month where the housing market was at a virtual standstill for a recovery towards more normal levels of activity. In the UK, this will of course be dependent on what government recovery plan looks like in terms of the social distancing rules around buying property. Now, more details are starting to come out, but we haven't had any official guidance on that yet. It's going to look slightly different, but it's certainly not going to be impossible to carry out viewings. And we're waiting for more details on that. And I think what informs the government's thinking is the multiplier effect that the housing market has on the wider economy. So every house sale, of course, involves a lot of extra spend on removals, on renovations, and the government, I think, is aware of this multiplier effect for the wider economy, not just in the housing market. Next slide, please. And what continues to be true, despite everything else that's going on, is that there are sizable discounts by historic standards for overseas buyers. So the pound, as you can see from this chart against the dollar, has been volatile. It's come back from its recent low, but it's still at a level that represents a significant discount for overseas buyers. And this, we believe, will help to drive demand, particularly in prime markets in London and the southeast of the country. Next slide, please. Now, if you look at a range of overseas currencies, the Singapore currency there in the middle, what you can see is that there are still discounts of 20, 25% plus for many currencies in prime centre London compared to before the EU referendum. Now, this discount takes into account currency movement, but also the house price movement as well. And these discounts are huge. They are huge by historical standards, and I think easy to overlook given everything else that is going on at the moment. With your investor hat on, certainly worth bearing in mind. Next slide, please. Before I finish, I want to give you a quick snapshot of what is going on in the lettings market. And this data relates primarily to London, where Knight Frank have offices. Now, tenancies, of course, involve a smaller financial commitment, therefore a fixed period of time. And it's probably unsurprising for many of you that we've seen evidence that tenants are starting to plan for life after the lockdown ahead of buyers. So what the first set of arrows shows is that tenant demand has come back to some degree. In the first week of the UK lockdown, which was the week ending the 28th of March, most people simply froze, and you can see the number of tenants registering fell by 59% versus the 5-year average. However, by the middle of April, it was only 28% below the 5-year average. And this is a pattern that we're starting to see. Slowly, people are starting to prepare now for life after the lockdown. It's happening also in the sales market, as I say, at a slower pace from a lower base. So, for example, the equivalent figures for new buyers registering in the week ending the 28th of March, we saw a 75% fall for people looking to buy, and by the 18th of April, that had turned into a 57% fall versus the 5-year average. Web views for lettings, we've seen an increase over the period. So in the first week of lockdown, web views were largely flat against the 5-year average, 1% up. That has turned into a 10% increase in later weeks. Perhaps finally and unsurprisingly, we've seen the number of tenant renewals, in other words, tenants staying put, increased by 15% since lockdown measures were introduced, and that increase represents a 10-year high. So overall, what's true to say is the lettings market has been a little bit more responsive than the sales market during lockdown. Next slide, please. A couple more slides before I finish, and this penultimate slide really, I think, will also be of interest to investor landlords. And I'm sure it's something many of you are aware of. It shows the relative performance of residential property versus other investments. In this case, we picked the FTSE 100. We've seen a lot of volatility, of course, in financial markets in recent weeks, not getting what's happened with the oil price. I think it's of interest, and what it shows is quarterly price changes and underlines, I think, what probably many of us know, that property is inherently a less volatile asset than other asset classes. That's precisely why institutional investors hold it as a hedge in portfolios of stocks and bonds. Now, next slide, please. This is just now my attempt to draw some conclusions to pull all of that together. And I think what we can say, really, the first conclusion is timing of when the market emerges from this situation is unclear. Science will ultimately dictate that timetable, and there is not much precedent for that in modern times. I think it's left a lot of people feeling quite disorientated. But what we can do is anticipate how the property market emerges from this. Of course, how is related in some way to when we emerge. And if we put everything together, we can conclude, I think, fairly confidently that this won't be the same roller coaster ride of 2008 2009. And unemployment is not forecast to be as prolonged. The interest rate environment is completely different, which is one of the reasons that supply and demand dynamics this time around are also unique. And furthermore, importantly, not to forget, we've gone into this downturn after many years of repricing, which again is a completely different scenario the last time. So as a key takeaway overall, what I'd say is that the exit for the property market from this situation should be smoother. And in other words, what this isn't is the global financial crisis Mark II. That's it from me. Thank you very much for listening. I'll now hand over to Jamie, who will talk to you about tax.
Thank you very much, Tom. Hello, everyone. So I'm here to talk to you today with an overview of the 2020 budget changes, and also talk through some of the more recent tax changes that may have escaped your attention. So a little bit about us briefly. We are a full service accountancy firm based in London. We were established in 1933, and we specialise in advising UK and foreign property investors who are investing into the UK real estate with a particular focus on the overseas market. That's my particular area of focus. What I'm going to talk to you today is, as I said, about the 2020 changes. We're going to talk through some other changes that took effect from the 6th of April that had been announced some time ago. We're going to look at a finance cost example of how the restriction on loan interest for individual landlords affects them. We're going to look at some capital gains tax, some inheritance tax, and a reminder of A10 and who it does and doesn't apply to. So the 2020 budget saw an announcement around stamp duty land tax for overseas buyers. And the government announced what it had consulted on previously, which is to be a 2% surcharge that will take effect from the 1st of April 2021. And I think it's worth clarifying at the outset exactly who this is going to apply to. So firstly, one looks at where you've exchanged your contracts on a purchase and then when you complete. So if we look at anyone who exchanged prior to the budget day, which was the 11th of March 2020, where you have a completion before the 1st of April 2021 and you exchanged before the 11th of March 2020, you won't be affected by the 2% surcharge. Where you exchanged before the 11th of March 2020 and you completed after the 1st of April 2021, you're in a maybe position at the moment, and I'll explain what I mean by that in a minute. Where you exchange after budget day on the 11th of March, but complete before the 1st of April 2021, you still won't be affected by the 2% surcharge because you completed before the effective date when the new surcharge will take effect. Where you exchange after the budget day on 11th of March and complete after the 1st of April, then clearly you will be subject to this 2% surcharge. Now, going back to those people who exchanged before the 11th of March 2020 and complete after the 1st of April 2021, the text that was released by the government stated that transitional rules may be introduced to protect investors who had exchanged on contracts but don't exchange until after the effective date in April. Now, if we look back to previous stamp duty changes that have taken effect, those stamp duty changes did protect investors who had exchanged prior to the effective date of the legislation. And so we would expect the government to go down a similar route and protect those investors. But at the moment, the government has only indicated they will issue further guidance in due course. Now, other changes that came in that had been pre-announced relate to overseas companies. So those investors who use overseas companies to acquire UK residential property. Big change for them is that overseas investors are going to now pay UK corporation tax rather than income tax on their rental profits. Now, this has an effect in two ways. Firstly, in relation to how you calculate the tax that I'll talk about later, and secondly, in terms of the filing obligations for you. So hitherto, overseas companies actually paid income tax under the self-assessment rules. That changes from April 2020, and they're brought into UK corporation tax, as I've said. The filing rules are different. So tax returns are filed 12 months after the year end of the company. So for companies with a December year end, you would need to file by the following December. And the tax payment dates are also different. You now pay 9 months and 1 day after your year end, rather than pay by 31st of January following the end of the UK tax year under the income tax rules. Now, those who have existing companies that own UK real estate is levying it out, they're going to receive new tax references they must use to file. You cannot use your old UK tax reference. There is also a requirement to submit accounts to HM Revenue and Customs, which includes a profit and loss and a balance sheet as well. So this will be the first year you're going to be asked to produce balance sheets for HMRC. Now, if we look at the first tax period, this legislation takes effect from the 6th of April 2020. So for a company which typically has a 31 December year end, your first period of account for this purpose will run from the 6th of April 2020 to the 31st of December 2020. You're going to need to pay your tax by the 1st of October 2021, and you're going to need to file your tax return by 31 December 2021. And lastly, the UK corporate rate has now been confirmed at 19%. There was a proposal to drop it to 17%, but this has been shelved by the new Chancellor. So the effect on finance costs, this is another effect that the change from income tax to corporation tax will have. So we know over the last 3 to 4 years, there has been a change in how tax relief for mortgage interest is given for individuals. So individuals are restricted such that from 6th of April 2020, they only get 20% tax relief for their finance costs, so including mortgage interest and costs of refinancing. Companies do not have such a restriction. They are only restricted where your interest expense exceeds £2 million, so only for very large companies. I'm going to now walk through an example of the restriction for individuals and how it operates. And I'm going to use an example, which is an individual who is not entitled to a UK tax-free allowance, so they're not a British passport holder or an EU passport holder. They receive rental income of £60,000 a year. They have nominal expenses of £5,000 and they pay £30,000 of mortgage interest. So their economic profit after paying all of those amounts out is £25,000. So if we move on to the example, the tax year which has just passed, which is a 2019-20 tax year, where you need to file your tax returns for individuals by 31 January 2021. If we look, they have rental income of 60,000, they have costs of £5,000. They can deduct a quarter of their interest costs of 30,000, which is £7,500 to work out their profit. They're taxed at 20 and 40% under the progressive UK system. They then take the balance of their finance costs, which is 3/4 of the £30,000 of mortgage interest, and they take that as a tax credit at 20% to work out their liability. It gives them an effective rate of 28% overall. From April 2020, so if we just go back, sorry, to the previous example. So from April 2020, if we look at the side-by-side comparison, we can see there's no deduction for interest in the right-hand column at the third line down. So our profit that is subject to tax is higher, and instead we take a tax credit of 20% of our entire interest cost of £30,000. It increases the liability by £1,500, and the overall effective rate on the tax is up 6%. So this is the final effect of this slow withdrawal of the tax relief on interest to restrict the credit to 20% rather than allow you tax relief at your marginal rate. So some other changes, capital gains tax has changed from April 2019, and there's also been a change from April 2020 that I'll come on to. So capital gains tax was widened in April 2019. So now catches what we call indirect disposals of property-rich entities, and also commercial property was brought within the scope of capital gains tax. An indirect disposal is what we mean by selling a shares in a company that owns UK residential property or UK commercial property. Essentially, it's where more than 75% of the asset base is made up of UK real estate. So any disposals of shares will be liable to UK capital gains tax. Because it was a new rule introduced in April 2019, where you have an indirect disposal, you can take a valuation, whether that's a valuation of the commercial property or a valuation of the shares in a property-rich company, as at April 2019, and you only pay tax on the growth in value over and above that valuation in April 2019. Where you have a disposal of a UK residential property, the rebasing date is April 2015, because that's when the effective date of the legislation was introduced to tax non-residents on disposals of UK property at that stage. There is a change that actually affects all taxpayers, both UK and overseas taxpayers. So from the 6th of April 2020, there is a requirement for individuals and for trusts to notify HMRC of any disposals of UK residential property and pay the tax within 30 days. So that applies to UK and overseas investors. All individuals have a tax-free exemption of £12,300, and the capital gains tax rates are 18% and 28% for residential property and 20% for commercial property. Companies no longer have to file these non-resident capital gains tax returns. Because they have been bought within the UK corporation tax regime, they are taken out of non-resident capital gains tax filings, and any disposals of UK residential property will be put through the UK corporation tax return. So moving on to inheritance tax, and the inheritance tax rules changed in 2017, and I think it's worth just reminding ourselves who this affects. So UK domiciled individuals, so individuals like me that are born and bred in the UK to UK parents, we are exposed to UK inheritance tax on our worldwide assets. For overseas based investors who are not domiciled in the UK, you are only liable to UK inheritance tax on your UK residential property assets. So it excludes commercial property, but includes residential property. So in terms of exposure, how does this work? It's exposed on assets you own directly in your own name. It also catches assets owned via a limited company, whether a UK limited company or an overseas limited company. And it also catches trusts, although trusts are subject to a special tax regime, which I'm not going to cover in this presentation. But they are liable essentially to 6% of the trust assets every 10 years is the level of charge. So going back to individuals, if we move on to the next slide. When we talk about residential property assets, what do we mean? Well, clearly we mean a UK residential property, so the bricks and mortar that one owns. We also mean the shares in a residential property owning company or a share of a partnership that owns a residential company. But we also mean a loan or collateral to fund a purchase. This would typically catch a situation where perhaps parents have lent money to their child in order for them to buy a UK residential property. That loan is itself treated as a residential property asset for inheritance tax purposes. Also, the proceeds of sale, so where a company shares are sold, where the underlying assets of the company were UK residential property, the proceeds of sale remain within your estate for UK inheritance tax purposes for a period of 2 years. So in terms of mitigating, firstly, the basis of charge. The way we charge inheritance tax in the UK is we look at what you own when you die, and we look back in the previous 7 years, look at any gifts you may have made to family members. Against that, we apply the tax-free allowance that each person has, which is currently £325,000. Spouses, any transfers between spouses is usually tax-free. So spouses can move assets between themselves on a tax-free basis. There is a restriction where you have a UK and a non-UK spouse, where any transfers from the UK spouse to the non-UK spouse can be caught. There is an additional main residence nil rate ban that was announced, but this only affects people where their estates are worth less than £2 million in total, and it also only applies where you have a main residence in there as well. So that's the house in which you typically live. It doesn't affect or is not available to be used against investment assets. In terms of mitigating, debt taken out at the point of purchase reduces the value exposed to IHT. So where you're taking out mortgage debt at the point of purchase, that will enable you to reduce your exposure to inheritance tax. What you cannot do is you cannot buy assets in cash and then refinance later on to obtain an inheritance tax deduction. That simply doesn't work for IHT planning. The only way it will work is if you are essentially taking out a mortgage on one UK property to finance the purchase of another UK property, because you're not reducing your overall exposure to UK tax at that point. Wills are vitally important in terms of avoiding intestacy in the UK. So if you die intestate without a valid will in the UK, then essentially what happens is the distribution of your assets is governed by UK law. Where that applies, if you die intestate with a spouse and with children, then 50% will go to your spouse, 50% will go to your children. That potentially triggers a tax charge because only spouses have the ability to transfer tax-free. Any transfers from parents to children is potentially exposed to inheritance tax. So as I've said, part of mitigation is about gifting assets and surviving 7 years past that 7-year trigger point, and then the asset is outside your estate. It's important to watch. We have a rule called gift for reservation of benefit. So if I was, for instance, to give an asset away to my child, but I still retained the rental income derived from that asset, the UK will not regard that as a valid gift. They would simply view that you've assigned it over but retained the benefit of it. So we would disregard that for inheritance tax purposes. I think it's worth considering using the interspouse exemption where possible. So you're really only focused on inheritance tax planning from a UK perspective on the death of the second spouse rather than the first. And I think the other 2 points are more commercial points than tax-driven points. So where you do have a UK tax liability, it's worth considering life insurance to cover yourself in respect of any tax charge that may arise if you were to die, and also how long you're likely to be exposed in the market. Because if you are investing not for generational assets, but only for time-limited periods, then clearly your inheritance tax only runs for the time that you are invested. So therefore, think about that risk during that time and consider perhaps term life assurance cover just to give you that coverage whilst you're invested into the market. So lastly, A10, and there's a confusion quite a lot of the time around A10 and who it applies to. So I think the underlying part of the slide is the most important. The charges only apply, these A10 charges, where you have a property that firstly is owned by a company and it's available for the occupation by a director or a shareholder, and the property is worth more than £500,000 a year. Unless you satisfy all of those, you don't have to worry about the so-called A10 taxes. And what we mean by A10 taxes is firstly stamp duty land tax, which applies at a straight 15% rate on the purchase. That will go up to 17% once the 2% supplement comes in. And then also the annual charges that one pays every year. These charges were originally introduced to counteract the benefits that of inheritance tax that owning via an offshore company would give. Those benefits were removed when the inheritance tax changes were made in 2017, but nonetheless, the annual charges still apply. Now, for anyone who's got a company which has residential property in it that is let to third parties, which is very, very common, it's important that the exemptions are claimed. So the exemption form is filed every year. So lettings to third parties is one of the exemptions. Property development is another exemption. So it's possible to claim the exemptions and not face these annual charges. But it's important that the annual returns are filed. So that's it. I think questions are going to come at the end. So I'm going to hand over to David now to talk about the UK mortgage market.
Thank you, Jamie. Very, very interesting, and obviously to Tom beforehand. And thank you everyone for having me today. David Hall, I run New Homes Finance for Knight Frank Finance, and today we're going to go through a bit of an update on the mortgage market. We're going to look at what's been happening during COVID, so what mortgage repayment holidays for people who have mortgages already, look at mortgages that are in process and what's been happening on the practical side on that side. Talk you through pricing availability, look at some of the restrictions that are sitting in the market, and then end on the sort of during and post COVID-19 era for those lending mechanics. So if we just move on to repayment holidays, number one question that we've been asked as a brokerage and as advisors since the pandemic is, I can't make my mortgage payments temporarily. What happens? Am I covered? Specifically for the international investor, the UK government is supporting the UK banks in these payment holidays, and it doesn't impact your UK credit rating in most instances, and everybody qualifies. So a payment holiday is a bit like an interest deferral. So we've just got a bit of a worked example for you here. It will mean that your loan is marginally increased, but if you look at owing £100,000 on a UK asset with a 3% interest per year, you've got a £250 annual interest charge. If you defer 1 month's interest, then it'll just mean you owe £100,250, and therefore recalculating 3% on that larger loan will mean that your future payments increase by 63 pence. So over 1 month, not dramatic, but that has a compounding effect and does need to be taken into account. It will go up and up. Eligibility, and this sort of part of the reason for putting this into the presentation today, is that anyone with a UK mortgage is eligible if they need it. So you can apply for a payment holiday directly with the bank, but it has to be for a reason. There are instances where people are sort of trying to look at taking advantage of this situation. But if there is a financial impact to you directly, which means that maintaining the payments on the mortgage will be difficult, then you should qualify. A lot of the time at the moment it's with either rent reductions or rent pauses from tenants that are triggering these instances, and that should be an eligible criteria. In terms of how you do it, it's directly with the bank. The banks have set up departments to take your calls and queries, although what we would say is that it's much easier to do it online. So where the bank has an online facility, a web portal, we would say apply directly through them, or contact a brokerage, your brokerage, or us as a brokerage to help you go through that process. We're very happy, and most mortgage brokers will be very happy to sit on a call and talk you through the process of doing this online and make sure that everything is done correctly. But it's definitely the best way directly with the bank. In terms of mortgages in process and cases that have been offered, another big query that's come up for us at the moment for investors, whether UK or international, is that the practical completion has been delayed. Building work was stopped temporarily in the UK. It is back up and running at the moment, but supply chains have meant that practical completion dates have slipped. If financial circumstances have changed for an applicant, then the bank must be notified. But if you're in a situation where you have a valid mortgage offer and it's going to expire because the property won't be built in time, the banks are offering automatic extensions for between 1 and 3 months without asking any questions. This is on a proactive, not reactive basis though. So what we're appealing to our clients to ask, and to any mortgagees within the market, is that you need to speak to your bank directly, or you need to call your mortgage broker before offer expiry. If you make that call, they will do everything possible to get it extended, and it should be a relatively simple and relatively painless process to do it, but it's on a proactive, not reactive basis. So if you let your mortgage offer expire, it's going to be a lot more difficult to get that reinstated. Pricing, well, the effects on pricing at the moment are vast. Not so much the pricing itself, but what's impacting it. So we look at the human resource, market liquidity, general market factors, operational factors, and then the loan to value that you're looking to borrow at. We've got some examples of pricing put out in the next slide, but to give you an idea of sort of major movements in the market and which lenders are coming in and coming out. The biggest one for the international investor is that HSBC has temporarily paused all of its investment lending, so no buy-to-lets can be done with HSBC as we present today, and that may change, but that's how it sits. Within that as well, you've got somebody like Kensington Mortgages who do offer a reasonable international product. Lenders that are currently paused in the international space, people like Skipton International and Arley United Bank, who offer quite a dynamic solution. So they're taking a breath at the moment while they sort out issues with valuations and ability to enter properties to do formal surveys. But one of the heroes of the market, and somebody that's sort of an unsung hero, I guess, from our side of things, is Barclays. Barclays International, so the lending arm of Barclays Group to non-UK residents, has increased its ADM values and actually increased its loan to values in the market since COVID-19. They are able to get up to 75% in the market at the moment, and they will automatically value through their desktop system up to £1 million. So they do not need access to properties. In terms of pricing, just to give you sort of a cross-spectrum idea of sort of what's available in the market today. These rates were produced last night, so they're pretty live at the moment, and we haven't seen any indications of movements so far today. Looking at the residential side, so if you were buying for own occupation or for family occupation, so something like a son or a daughter coming to the UK to study, you can get a UK residential rate at the moment as an international buyer, 2-year fixed rates at 1.29% and 5 years as low as 1.51. That's actually directly comparable with a UK residential rate. So should it be me applying for the same type of product, I would probably get almost the same, or maybe 0.1 basis point lower. So it's very, very, very competitive. Core markets on the buy-to-let side, so anything under really £2 million in lending. 2-year fixed rates are still under 3% at 60% loan to value, and able to get up to 75%, as I mentioned, at 3.75% on a 5-year fixed rate. both the 5-year fixed rate in the core market and in the larger loan market, so that 3 million plus space, you can borrow more money because you use an enhanced multiple. It's probably outside of the scope of what we're going through today. But if you take a rate that's guaranteed for a longer period of time, under the guidelines set out by the Prudential Regulatory Authority, we're able to be more flexible with the amount of money that's lent, and that's why those rates get you slightly higher 5 and 10-year products. Okay, moving on. So loan to value restrictions. Actually, this when we put this slide together, it was at the back end of last week, and things have moved on since then. So what we were saying is that loans out of market uncertainty, not a lack of willingness to lend. What we go back to is my comment earlier on human resources. We had a situation early on in this pandemic where the banks didn't have enough people working in the right departments to satisfy certain parts of their business. So what happened was, or if you imagine a scenario where 75% of banking staff sit in the new loans division of a bank. So they're the people that write the paperwork, do the underwriting, process the applications, check the documentation, that sort of thing. And only 25% or so sit in the back office for the loans that are already in place, because once a mortgage is up and running, it doesn't really take much maintenance. There's about 97% payment rate on UK mortgages at any one time. So there's not a lot of resource that gets put into that. With COVID-19 and the implementation of the sort of government endorsed payment holiday situation, there were a significantly increased volume of applications for payment holidays, which meant that the banks had to take people from their front line and put them into the back office. And that meant that they just didn't have enough people in the front to incept and sort out and deliver loans. As this pandemic has matured, we're seeing those people return to their normal departments, and therefore the bank capacities have increased. And we've seen that this week. So where we've seen loan to values dropping in some sectors from 80% down to 60 or even 55%, most of the banks that have done that have actually moved back up towards 80% already. Investment lending throughout the process has been less impacted than straight residential lending, and that really is because the loan to values in that market were already lower, so they already were at a lower level of capacity. And the only other thing to note, I guess, on this side of things, that even where there are loan to value restrictions for existing mortgagees, so people who already have mortgages that they took out and would currently be in a situation where there are no mortgage products available. So you took a mortgage at 75% loan to value, and now the bank is only offering a 60% loan to value mortgage. It has been guaranteed that there will be no mortgage prisoners. So even in those instances, the banks have to offer refinancing rates that are competitive within the market. So yeah, moving on to my final slide, really. Information is key throughout this process. In order to make sure that the best solutions are possible, we need to look at various different parts of the market that we wouldn't normally need to access, accessing alternative niche and smaller lenders, which there are many, and there are more and more entrants into that market. Some of the boutique funds and private equity vehicles that see UK property as a secure investment and a good return are looking to put products into the market, and we've had very interesting discussions with various parties on that side. Increases in automated and desktop valuations, so where we have the restriction of movement of people, it's who and which banks have the ability and appetite to use these financial models or these property models to give them the comfort that the asset is worth approximately what they're lending at, and that has been an increasingly interesting part of the market. You know, people, as I mentioned, like Barclays International, really taking that up, and we are seeing more lenders that are in that space. Capacity to transact is really going back to that human resource issue, and then understanding a lender's exposure to different borrower subsectors. There are different times when different banks want to take on different types of clients to balance their risk book. And as a brokerage, we're acutely aware of sort of where that might be. There are times when banks only want first-time buyers, or they want high leverage or low leverage clients, and it's about understanding why they might be kicking back on something and understanding that balance in their book. And then finally, yeah, so these are just the contact details. Should anyone want to pick up and discuss either existing mortgages or future mortgages, I would personally be very happy to take those calls, but my two team managers, Oliver Sandler and Nathan Backbacky's details are there as well, and they are very happy to take calls or emails whenever anyone would like. Thank you very much.
Thank you, panel. Lots and lots of great information, and certainly lots for us to digest over here. We do have a couple of questions for all of you from the floor. So I will read them out, and the first one is for you, Tom. It's kind of two questions pulled into one. First, could you add some further commentary onto the prices, both in terms of sales and rental? And of course, we are in an unprecedented environment at the moment, but how do you see the 2% surcharge levied on non-residents affecting the market, both in the lead up to the 1st of April 2021 and then thereafter?
Sure, thank you, Nick. In terms of the first part of the question, I think what our forecast for 2020 is a case for a 3% decline across the UK, flat in prime London. And making forecasts or short-term forecasts at the moment is a tricky thing to do. We're in a very fluid situation, and the forecasts are subject to review. Now, over the longer term, over the next 5 years, for example, we're more comfortable to assume that that link between UK GDP and the housing market will start to reassert itself a little bit more. We're confident of double-digit growth over the next 4 or 5 years. But I think at the moment we are just we're keeping a constant eye on our price forecast. So some people have said, are they too optimistic? There are other forecasts out there that are a lot more pessimistic. What I've hoped I did is set out why we think those forecasts are the right forecasts at the moment. This is not a rerun of 2008. I know lots of people will reach for that as the most convenient sort of yardstick. We don't believe that's an appropriate yardstick. It feels to me more like 9/11. It's not a perfect. It doesn't mirror what happened in 9/11 perfectly, but you're looking at sort of similar features. There's a slight retreat from globalization. There's a fear, a concern over loved ones. It feels like it's more like a situation in 9/11. If you look at what happened in the UK between 2001 and 2005, the economy, just grew and grew and grew at a very strong rate. So it's still quite disorientating for people to try and understand what's happening, and when we emerge from this, as I say, it's difficult to know. But how we emerge from this, I think we can. There are forecasts that for rents, we think this year we'll probably lose around 25% of what we'd expect to see in a normal year in terms of those tenancies agreed. There has been historically over the last few years very strong demand versus supply in the rental market. Lots of landlords have simply had enough of some of the taxes and have left the sector. So that's pushed down supply. Demand is very strong, however, which has been really putting upward pressure on rental values. Now, that's how we went into this, which will obviously have an impact on how we come out of it. But yes, I hope that answers the question. Second part of the question, the stamp duty issue. I think what it'll do, and again, based on our assumption that towards the end of this year, we do get a recovery, and this week we could even hear how the market starts to come back to life, then you could see a situation where an awful lot of pent-up demand is coming out domestically. And from an international buyer perspective, they are absolutely looking at next April and thinking they need to transact before then. So you could see a lot of demand being squeezed artificially towards the end of this year, which is something that you should keep an eye on. More broadly around stamp duty, just to make this point finally, the people I speak to when we talk to them is, will there be a stamp duty holiday? Will the government cut stamp duty? At the moment, the answer is a pretty strong no. And the government, I think, has its own issues around keeping some of this lost revenue. So we're not expecting any cuts or any change to stamp duty. There could, however, be other measures the government takes to support you.
Thank you, Tom. Staying on you, we do have another question from the floor, and it's in addition to what you just shed light on. With Brexit happening towards the end of the year and a deal potentially being negotiated with the European Union, do you think this will create more economic upheaval and depress and have an impact on the property market further in the next few years?
What the property market has responded to in recent years has been the threat of a no-deal Brexit, in the same way as the currency markets have responded to it. My sense is that a lot of Brexit uncertainty has kind of been absorbed by the market, has washed through the market. I think what's happening at the moment is going to really put Brexit into some wider perspective. Again, it's a case of looking at what the respective parties are saying at the moment. There are signs that they perhaps could be what's happening at the moment could just kind of focus minds a little bit. I think there are certainly an awful lot of pressures in parts of the EU economically. Certain countries in the south of Mediterranean countries didn't go into this in a fantastic shape. There will be strong financial pressures, I think, being felt in parts of the EU. I think all of that will inform negotiations. I personally would expect it to focus minds and for it to become much less of an issue on the other side of this. It won't go away, and it's something to keep an eye on. But I think it'll just be dialed down in terms of how the rhetoric surrounding it.
That makes sense. Thank you, Tom. With Tom, again, for you, with the lockdown measures sort of limiting work on construction sites, do you see this having an impact on housing supply moving forward?
Thank you, Nick. Yeah, absolutely. I think the figures that we're looking at is around housing delivery down by about 35% in 2020. So that's around 8,000 homes in London. What we're seeing at the moment is that the house builders, or the volume house builders, are slowly starting up again. But they'll have to struggle, of course, with how the consumers are feeling. The sentiment will play an issue in this. I'd imagine that builders will prioritise sites where there are orders already completed. But we have heard some pretty positive figures coming out from the likes of Taylor Wimpey and Persimmon around reservations during lockdown, and around pricing as well during lockdown. It points to what I was saying around the supply and demand both sort of moving in unison and not being these huge double-digit price declines. We haven't seen any evidence of that coming out of the house builders. But yes, it will in the short term, of course, have an impact. But I think this is an area where the government could potentially look to intervene more in terms of extending things like their Help to Buy scheme, introducing greater flexibility around planning system. But of course, how long this goes on will be a key question. And I say this week, next week, we might start to see, from what we read in the papers, more activity outdoors, more flexibility around outdoor activity coming in. So things could slowly start to work back towards normal. But overall, absolutely things are going to be down in the short term.
Makes perfect sense. Thank you, Tom. The next question we have is we're moving on to Jamie. It's a question on tax. Jamie, so you quite rightly highlighted that over the last couple of years, there's been several changes to tax. So the question is it better to purchase in a company or an individual name or several names?
Thanks, Nick. It's a really good question, actually. And I think before it was pretty straightforward in giving people guidance in how to buy. And I think that has changed now. And I think everyone needs to look at their own circumstances when deciding the right structure for them. So the typical things I would think about in this regard are, firstly, as an overseas buyer, do I qualify for a tax-free personal allowance? If that's yes, or any of my family members do yes, or any of my joint venture partners do, then I'd look at that and say, okay, then that could be £12,500 of tax-free rental income I could receive. Companies don't get a tax-free allowance. So if it's the first property I'm going to buy, my first foray into the sort of UK market, then I might think, well, I'd buy it in my personal name. Then I'd need to think about the size of the property, the size of the debt I'm taking on, what's my mortgage interest payments are going to be, and am I affected by any of the financing restrictions? If I am going to be affected by the financing restrictions, I may think, well, okay, a company may be the right answer for me, but then I need to look at the savings I achieve with the company, because of course companies have an inherent cost to running them as well. So that all needs to be factored in. So there's no one size fits all approach. It's a matter of looking at each individual circumstances and determining what is the right structure for them.
Thank you, Jamie. I guess the key takeaway there is to speak to a professional before you make that decision. Moving on to David, actually, on a similar note. So, David, is it harder? Is it true that it's becoming harder to obtain a UK mortgage as a non-resident today? And would it be easier to obtain a UK mortgage purchasing in a company or as an individual?
Thanks, David. Another good question. It's more difficult for everyone. So it's just the environment that we're in. So yes, it is more difficult as a non-resident investor, but it's more difficult for a resident purchaser. So that's just the sort of the temporary flux that the market is in. There are still a huge variety of solutions that are available to non-UK residents when they're looking to purchase investment properties. So it's just about understanding the clients and making sure that we put the right solution in play. Whether somebody buys in an SPV or a limited company or in their personal name, it really depends on the size of the asset that they're purchasing as to which lenders that we can use. Effectively, or unfortunately, the larger the purchase, the less the differential between personal name and limited company. So if you're buying something for £3 million plus, the structure you use is almost irrelevant because the loan quantum is sufficient for the bank to spend the time to get everything in place and put appropriate pricing together. If you're looking at a smaller loan, maybe something under £100,000, there may be a pricing premium currently for a limited company, but we wouldn't expect it to be a long-term premium. So as the market returns to a level of normality, you won't be paying a significant premium to have it in a limited company. It's really back to Jamie on whether it's appropriate for the property to be actually purchased in that limited company or not.
Yeah, that makes sense. Thanks, David. And how should someone go about applying for a UK mortgage, and at what stage should they do so? Especially considering a lot of purchases here buy off plan, with sort of 2-3 years till completion.
So I've got my if I put my perfect client hat on for a moment, from our side of things, we'd love to be talking to clients 6 months before practical completion, so 6 months before they actually want to draw the loan. We can do it much quicker than that. If we're given a 4-week time horizon, we can put loans in place. But it's much better to have that 6-month lead in, because it means that we can deal with any hurdles that haven't been foreseen. And in fact, what we do with a lot of clients is we'll start the process at the point of them first reserving the property. So we're very happy to talk to clients on before they reserve, so they can get an outline of what we think is possible, and have a continuous conversation as the market evolves and as they get closer to that completion date. It's really about making sure that clients are fully aware of any changes in the market and any impacts if they're late to act.
Great. So about starting that conversation early, really, and continuously keeping a pulse on the market as we lead up to completion. Back to tax, Jamie. Let's see. How is capital gains tax calculated, and does the stamp duty one pays get treated as part of their total purchase cost?
Okay, so capital gains tax, it depends on when the property was acquired. So if you had a residential property in someone's own name that's acquired prior to April 2015, you would usually take the April 2015 market value as the base cost for capital gains tax purposes. That is then deducted from the sales price of the property. You also deduct from the sales price of the property all your ancillary costs, so the cost of your solicitor and any other costs you incur connected with the sale. They all come off in working out the capital gains. Plus, if it's an individual selling, then you get a tax-free allowance as well, which is £12,300 currently. Now, where the property is acquired after April 2015, then you take the purchase price of the property plus the incidental cost. That would include the stamp duty as well as the legal costs. But if you're using a market value rebasing at April 2015, then you don't take the stamp duty into account. You just take the market value of the property at that date.
Understand. And as a foreign purchaser, you mentioned about inheritance tax. So, for example, as a Singaporean investor and owner, would I need to prepare a will both in Singapore and in the UK?
No, a Singaporean will is absolutely fine. You don't need to have a will in the UK. It's often best practice to have a UK will and have your will perhaps in Singapore acknowledging your UK will, but you don't need to do that. You can have a Singaporean will that governs your UK assets. That's absolutely fine.
Perfect. Thank you for clarifying. It's quite a common question we get out here. And Tom, back to you. It's the last question we've got from the floor, and it's the million-dollar question. Is now a good time to invest into London property, and where do you see some of the best opportunities at the moment?
Thanks, Nick, for that question. Yeah, we certainly get that. We get that one a lot. I think it's a case of just looking at some of the broad trends rather than trying to pick out individual areas. I think if you look across the whole of the country or the whole of London, for example, you're not going to be able to pick out any one area that's going to necessarily respond better to what's going on than any other. It's something that's unprecedented. It's unlike anything we've seen before. It's across all markets. Employment is going to be a big thing to watch, and that is, as I say, that's across all markets. The two key things I think to bear in mind are, number one, history tells us that prime markets, particularly in London, respond better to these sorts of events. And that is down to the fact that the demand is broader internationally. And of course, the currency play comes into that as well. And the second thing to look at, which actually also plays well for London, is if you're trying to pick out which areas are going to come out of this differently to other areas, look at those areas where prices have done nothing or have fallen over recent years. And again, that actually does point back to central London. I'm not just trying to force everyone to look at central London, but those are the two things we would look at, and it does put central London at the moment in focus. I mean, if you're looking at the land registry data, the UK government data, there's two boroughs in the two local authorities in the whole country where prices have fallen over the last 5 years. That's Westminster and Kensington and Chelsea, two central London boroughs. Some other parts of the country, prices have grown by 30%, 40% over the last 5 years. So that has to have an impact as we come out of this in terms of how different markets perform. But I would say overall, it's just a case of keeping an eye on the market fundamentals, as I hope I've laid out today. And with somebody wearing an investor hat at the moment, should also probably be looking at some of the early signs that we're seeing from vaccine development, all those sorts of early medical signs as well. I think are important. I think, of course, the property market moves very much based on sentiment. If at some point over the next few months somebody says, okay, we have something that looks like it works from a vaccine point of view, that will take a while for it to be scaled up and have an impact on the wider economy. But the impact on sentiment is going to be pretty instantaneous, which will, of course, knock on to property markets. So, yes, there's a lot of doom and gloom around at the moment. You don't have to look too far to find that. But I think also for balance, you need to keep an eye on those sorts of things and be prepared, I think, to act quite quickly if needed.
Yeah, thank you, Tom. I couldn't agree more. I guess if anything is certain at the moment is that whenever there is uncertainty, there will always be some form of opportunity. So thank you. We've now come to the end of the webinar. So thank you, panel, for your wonderful insights. Thank you to everyone for spending the last hour with us. If you do have any other questions that weren't covered, please feel free to get in touch with us. We hope you found this session very insightful, and do stay tuned because we do have several more sessions planned in the coming months. Obviously, to help us continuously improve so that we can serve you better, we'd love to hear your feedback. So on screen, you'll find a QR code, and alternatively, there is a link that will be in the chat box where this can be done. Thank you once again. Stay safe, and we look forward to seeing all of you very soon.